Hey everyone, Anthony Venuto here with InTouch Mortgage Solutions. It's Friday, Finance Fridays, and on this episode, we're going to be talking about what the banks are doing to help clients who are finding it hard to afford their mortgage payments. Stay tuned, you don't want to miss this. If you're watching this video on the Team Sessa YouTube real estate channel, once again, thank you for clicking and thank you for all your comments. Don't forget to leave those comments below, hit that like, share, and subscribe button, hit that notification bell so you can get notified every time we post a new video. And if you want to book a free consultation with myself or Santo, you can do that in the description box below. But now, back to the video. Over the past several weeks, we've been hearing from some of our clients, even new clients, and having conversations with colleagues about what the banks are doing, the major banks are doing to help clients with mortgage affordability. And obviously this has been a major concern as we've seen the Bank of Canada steadily increase its policy rate over the past 7 months and potentially with another increase in December, causing at least 50% of Canadians, according to Governor Tiff Macklem, to breach or hit their trigger rate.
I mean, we've raised interest rates rapidly. That is having an impact, particularly with people on variable rate mortgages.
Which is a fairly small number, I guess, on variable rate mortgages.
Most people have fixed rate mortgages, the 5-year being the most common. Some, more people than usual stretched to get into that market. And one of the ways they did that was they took a variable rate mortgage. As the question mentioned, a lot of them had quite high loan to value mortgages with variable rate mortgages. So it is not the biggest part of the market, but it has gotten bigger through the pandemic, and that is a vulnerability. That is a source of concern, and it does mean that this adjustment to higher interest rates is painful for that segment.
Now, just to do a quick recap, clients who are on variable rate products are obviously more susceptible to these payment shocks and changes, which is basically causing some interruptions for some of the lenders in the marketplace, and obviously for some Canadians as well. Obviously, there's been a lot of situations that have come to light over the past few months when it comes to Canadians and their ability to service their mortgages. Now, obviously, this begs a larger question, but speaking with some of our clients, here are some of the scenarios that we have heard and what the banks are actually doing in order to help their clients stay in their home. Now, before we get into it, it's important to enter this caveat that lenders do not want to be landlords, and that lenders basically do not want to have to go through the process of a power of sale in order to evict clients or homeowners from their homes. This is something that the lenders will try to avoid at all costs. And obviously, based on OSFI, the Office of the Superintendent of Financial Institutions, they need to actively be prudent in their decisions on how they're going to manage these potential risks. So one of the clients that we had spoken to was with a different institution than we work with, but the client had asked for some advice and heard about us, and they reached out to us with some scenarios that they wanted to see what they could do. And obviously, because one of the individuals had lost their job and they were not able to qualify for a mortgage or a transfer to a different lender, the client had basically looked for other options, and we advised the client to reach out to their institution, but we asked them if they can report back to us with the actual solution. And a few weeks had went by and the client had reached back out to us, and the client advised that based on their circumstance and the fact that they were on an variable rate mortgage with a trigger rate, which meant they had a static payment, because they got the notice they were looking for their options, they were asked to increase their payment by a few $100s. Now that few $100s, it's important to point out, was not going to cover any principal. The increase in the payment was just to cover the interest portion. So that client's payment was all interest bearing. And the client was okay with that, but the client was in a situation where the family couldn't increase their actual payment because that one person lost their job. And when they went back to the branch and they had spoken to the individual, the lender advised them that we can apply for an accommodation or an exception to see what they could do. And what they ended up doing was increasing the client's principal amount to cover the difference in the interest that was short. So the shortfall between what they were required to increase, they were able to add it back into the principal. Now this I found very interesting because the bank had allowed them to increase that principal. Most banks will not allow that principal balance to increase above what was registered. Some banks will not allow their amortization to increase past the registered amount, whether it be 25 or 30 years. And obviously with some of these trigger rate mortgages, a lot of these clients that have breached these trigger rate products, if they're looking online, they may find that their amortizations have skyrocketed from 25 or 30 years to 55 or 60. And some lenders who actually don't even report the actual change in amortization. And this was an interesting conversation that we had because we'd spoken to other colleagues. And obviously this was great that the lender itself was able to accommodate. But the question is, what happens down the road? And speaking with some of these clients, we had talked about their mortgage. They were in a 5-year product, and the fact that they had deferred their mortgage earlier on in 2020, which had further increased their principal. And now with this additional increase to their principal, what will that amount be? And because of the fact that these clients were in an insurable mortgage, meaning they had purchased with less than 20% down, what was the value of their home? What was the mortgage balance in comparison to the actual principal versus the actual home value, the loan to value on this?
If people lose their jobs, they're going to have a hard time covering their mortgage. And if they have a very big mortgage, if their house price comes down, even selling their house may not cover it.
And you get to start to think about what could happen down the road. And obviously it's too soon to tell what could happen with clients when their principal amounts increase significantly, and then when they have to go renew this mortgage or when they go to pay it out, obviously, or refinance that mortgage, will they have the equity to do so? And are they going to be hand tied to that lender? And will they allow them to continue that amortization? Because from what we gathered so far, obviously, it's important to understand that that amortization has to stay within 30 years as a maximum at the current moment. And by having an amortization that's surpassed 60 years, bringing it back down to 30 means there will be a payment shock to this particular client, and not including what the interest rate will be when that client goes to renew. So it was great that the client was able to continue on, but what will they kick the can down the road? What will the problem be down in the future? Let us know what you think in the comment sections below. Now, in opposition to that, we had a client with a different lender, and they were on an adjustable rate mortgage, meaning their payments were changing. And the clients themselves were actually in a situation very similar. One person had gone on mat leave, and obviously their income levels had changed. They were able to make the payments, their payments had gone up, and the bank themselves had basically advised the client that they could re-amortize that mortgage. So the client, when they renewed, were around 20-year amortization. The lender allowed them to re-amortize back up to 30 years, keeping the existing rate. And obviously this was a case-by-case example because of the situation that the client was in with the job loss, or the client actually being on mat leave. So this was a particular scenario that the lender was able to help. And it got us thinking about the banks themselves are looking to make sure that clients are able to stay in their home, and basically also make sure that the default rates in Canada do not increase. I mean, that's just my take on it. I don't think the banks want this to actually happen. They don't want people to start defaulting on their mortgages. And this is a very important conversation that we're having. And as this data starts to roll out, I mean, a lot of the banks are starting to showcase that there are some significant upticks in these types of requests, but it's not for everybody. That's a very important conversation that we're having with clients. We've seen from some of our clients, they are in very precarious situations, life-changing events causing them not to be able to afford their mortgages. I'm assuming there's probably going to be a lot of clients out there that maybe overstretch themselves and leverage themselves to the nines. And obviously, they're working as hard as they can to make those payments. But I mean, most of the clients that we've talked to, we've heard from our colleagues, are not in that particular situation. It's been a life-changing event that has caused them to basically be in a situation where it's more difficult for them to afford their mortgage. And this is another question of how many Canadians are going to be in a situation where they will need some assistance from their lender to basically make ends meet. We did see this back in 2020 when the government mandated that lenders basically allow clients to defer their mortgages for up to 6 months and increase their principal amounts by deferring their payments and adding it back to the principal. And obviously that poses a problem in itself, because some clients that are looking to renew their mortgage, and obviously depending on their loan to value and the equity, if they've increased the principal amount significantly enough and the home value has dropped, depending on how much money they put down when they purchased or restructured. Obviously, there's a lot of questions here. And I want to know from our viewers, what are your thoughts on, are the banks actually helping clients by doing this, by helping them accommodate? Or is it just basically a bigger problem that's going to be, we're going to be dealing with down the road? Now, obviously, one important conversation is what's going to happen on December 15th, which touched upon OSFI, which is the Office of the Superintendent of Financial Institutions, earlier on, but in December, they're going to be meeting to discuss obviously these stress test rules and any changes that could come down the pipeline when it comes to potentially amortizations and shortening or lengthening some of these amortizations possibility, and changing the rules and requirements for the stress test rules and other changes that could be implemented on that meeting. And this could have a big impact on maybe why the banks are potentially looking at increasing some of these amortizations, or why maybe some of the banks are not really concerned with these amortizations and they're letting them slide. Because obviously each lender is independent. Each lender is required to report, or they do have regulatory bodies like OSFI inspecting them, not as often as they should be. But on that note, they are required to exercise prudence when they look at these regulations. And obviously over the past little while, we have seen some of the bank's guidelines change when it comes to their loss provisions on the amounts of money they have to keep in reserve. So obviously there are a lot of questions that are coming up in this particular time. And for a lot of clients we've been talking to, and even some industry professionals, some of them are on either side of the fence when it comes to, have we hit an inflection point with home prices and values, and buyers and sellers digging in their heels? And obviously the more important question is looking at some of these default rates and what will happen moving forward. So I do want to basically advise that on the 15th, we will be talking a little bit more once we hear from OSFI. And if you want to get that information when we do the video, don't forget to hit the like, share, and subscribe button and that notification bell so you're notified when we post that video. But we will leave the video here, and we hope that everyone had a great informational session right now, and as well as we wish everyone a great Friday and even better weekend ahead. Thank you for clicking, and thank you for tuning in.